Good afternoon, everybody, and welcome to today's webinar. I'd like to welcome those a good afternoon that are here in Eastern Canada and saying hi to our friends out west in the morning time zone. So my name's Dave Price. I'm the Director of Sales here at SVN Rock Advisors. And, you know, at any time throughout and afterwards, there's my QR code. You can contact me either through cell, email, or book a time with me. And you'll learn more about why you might want to do that as this webinar goes along. So a little bit of housekeeping here. So as a as our next follow-up to today's webinar on May 6th, we're running a Leasing Insights, the pulse on today's property management market. That's where we'll be following up on this topic, and you'll get some valuable insights from that one as well. But you can also see up on the screen that we've got a scary time success program for apartment owners, right? Vacancy is a critical topic here. You'll be learning more about that a little later on. Derek will give you some details on that. But the QR codes are up there. And what I want to let everybody know there, you can see the Q&A. If there's any questions that you have or topics that you want to hear about, put it in the chat. Any specific questions, we'll cover those at the end if we've got time, but don't make them easy questions. Come at us, challenge us. We've got a lot of insights and experience, so let's have a real conversation. So I'd like to introduce to you the one and only, our featured speaker, Derek Lobo, CEO and broker of record at SVN Rock Advisors. Derek, over to you.
Okay, Dave. Thanks very much, and thank you everybody for joining us. We do these webinars, throughout the year. Sometimes they're on sort of run-of-the-mill average topics. Sometimes they're on sort of flash topics and so on. So you've all heard enough about the Trump tariffs, right? It's just like we're tired of it. Everything is about that. It's going to be what it's going to be. But I think that what it's brought on is for the apartment industry, both in terms of development, ownership, and management, its risk is off right now, right? People don't want to make decisions, and so there's little decision making going on, whether it's to build a building, buy a building, or rent an apartment unit from you. And you can understand that renters don't want to make big commitments also, and maybe that's part of your strategy, understanding how the renter is thinking. So there's a general risk off environment right now because things are uncertain, and when things are uncertain, nobody does everything, including your clients, the renter, and including our client, the apartment owner. But there is, within all these things, opportunity. There has to be, and that's why we're in business, because we look for opportunities. And I think that certainly the opportunities are. I think logically we would expect lower interest rates. Everyone's expecting lower interest rates. That's generally good for real estate. I think you can probably expect more favorable apartment building policy, certainly not more favorable landlord and tenant policy. That just kind of seems to go one way. But I think you would expect more policy coming out federally, whoever that is running Canada, and provincially, and so on. And I think, maybe the lower Canadian dollar, if we're looking for, a silver lining here, that could make, Canada more attractive for its products, its services as a vacation destination, and so on. Okay, Rod. So I post quite a bit on LinkedIn, and you can just connect with me there if you'd like to. And I try to keep my comments about the apartment industry. There's just so much talk right now on everything and everyone's opinion and so on. I'm trying to give factual advice when I can, and the unfolding story for sure is the tariff environment, but what impact is it going to have, on the apartment industry? So I'm trying to post relevant stuff that can help you in your day-to-day business. As we go through our normal business cycle, in a year we'll do, 20, maybe 30 webinars around the year. We've got one coming up on municipal taxes. Not has anything to do with what's going on in the marketplace today, just that apartment owners need to know about where municipal taxes are going, how to appeal them, and things like that. Later on the year, we're doing a session on apartment insurance, and just let you know that we're in the education business, and we want to educate our clients. And an educated client is a better client to us. We are consultants and brokers to the apartment industry. This is what we do behind us, for those of you that don't know as well. Something I started recently to do and really have enjoyed doing it is bringing a group of competitors together, apartment developers. We're doing it in London for about 6 months, and we're going to start doing it in Hamilton and Toronto on a monthly basis. It's apartment developers sort of breakfast. We meet from 9 to 11 in the morning and talk about our industry and opportunities that there are, challenges people are having. And it's generally it's a sharing group. It's a sharing group for developers only. And as Dave mentioned, I think that if you're interested in our topic today, which is sort of scary times, weird times, what's happening in the apartment industry, we're going to get a lot more specific on May 6th in terms of strategies to use for for the industry, right? Okay. Um, okay. Several times a year we do public events, and we've got two coming up June 10th, and this will interest condo developers. There are many condos that have been put on the shelf or sidelines or sidelined, and so we think a lot of condo developers are going to pivot to building apartments. We're doing a live session for them in Toronto. Once a year we run an apartment development masterclass. It's it's seven sessions that are 11 sessions that are 90 minutes each. And it is a primer to becoming an apartment developer, for pivoting apartment developers, for their staff, and so on. It's quite comprehensive. We've run it for the last 3 years. And then once a year we do a conference at Toronto Real Estate Forum. This year it's going to be December 2nd, and it's on apartment development and affordable housing. Okay, next slide, Rod. So whatever happens with the tariffs, whatever happens with the economy and things like that, I think it's pretty fair to say that whatever's coming at us in the future is going to be difficult. It's going to be bad. How bad it's going to be, we don't know, but let's batten down the hatches and prepare. And today I want to talk about getting ready for what is probably going to be difficult times. Okay, slide. So we don't want to talk about this guy too much, but it's certainly my tune on Donald Trump has changed, right? Many things he sort of did and were saying he's going to do made sense, but this certainly doesn't make sense. This certainly doesn't. Anyways, let's move on from this. Right, boom. That's it. Last time I'm talking about Trump for, anyways, a week. Okay. All right. So we're heading into what, and I use this term from a book that was written called Scary Times, right? And you're heading into something that is unknown in many places, but we're apartment people, so let's talk about apartments. But here's the author, a guy named Dan Sullivan, said, in scary times, focus on your client, not yourself, right? So for us, our client is the developer and the apartment owner. For many of you, your client is the resident living in your building. Let's not think about our problems are going to be, let's think about their problems. That's what you do in scary times, right? And focus on who we are. Forget about who we are. Like, we're brokers, we're consultants, so on. Who can we be? And so much has changed over the last 6 months. If you think about the apartment industry, we went from waiting lists to incentives in 6 months. Okay, that's unusual to happen. So let's forget about what's happened. Let's focus in on what our response to this is. And it's going to be better sales, better marketing, sharper pricing, and things like that, right? And then forget about our commodity, focus on our relationships. Like, you own apartment buildings, we own a brokerage firm, we own a laundry company, whatever it is. But let's focus on the relationships we have with the people we have. In many cases, focusing on your residents is going to keep your rents higher, and it's going to keep your vacancies lower. It's always that case, but it's more critical now. So focus on what your clients' needs are, and focus on the other person in scary times, right? So in terms of, whatever is happening right now is not good, but we don't know the degree of how it's going to be. But if you're going to be preparing for something, then let's prepare for something that could be much more difficult than what we've experienced, certainly in the last number of years. Now, if you think about the last number of years, let's say we took 2010 to 2020, that 10-year period, I would call that the golden years. Interest rates dropped, buildings were full, apartment building values went up, we were all well employed, we were all making money. Then from 2020 to about 2022 and a half, halfway through 2022, we were in COVID, but things were pretty good. I mean, there were a lot of challenges running buildings, but rent stayed high, rent stayed up, vacancy stayed low, and we got through what was a very difficult period. and tenants paid their rent. If you think back to, what we thought could have happened, didn't materialize at all. Then from 2022 and a half to, let's say, the end of 24 to about now, we went through a period of higher interest rates. And higher interest rates, cause problems in a business that's very much driven by interest rates, based on leverage. But in the last year, sorry, since Trump's been elected, and in the last month, I think we're heading into a more difficult period that's very uncertain. So we came from golden times. We had two hiccups, COVID and interest rates, and now we're into a longer period. And this period is probably going to go till Trump goes, and that's going to be till the end of 2028. So I'm going to call now till the end of 2028 sort of the disruption years, right? And this is going to be the scary times. And when things are difficult, if you just look short term, you're just looking into an abyss. You have to look through it into what I think after 2028, we're going to get a new normal. Fair enough? Things, you always come out of a recession, right? But what we're going to come out into may be different than what we expected. So let's just start thinking about that and preparing for that, right? So we are, Rod, next slide. We are going into recession, and recessions come and recessions go, right? Hard times come and hard times go. Rod, that's a Bruce Springsteen song. We should introduce the next seminar with that. And that's the thing to remember, right? Hard times come, hard times go. We're heading in a hard time. We're going to come out of it. This is a great country. You don't need to hear all this stuff. You read it all, all the time, but it really is a great country. We're heading into a hard time. We'll come out of it, and we're going to be, and we're always fine. So let's look through this. But so what happens to rents? As I said earlier, 6 months ago, everything was good. All of a sudden, we've got vacancies, we've got incentives, and we've got declining occupancy rates and so on. Typically, when a market turns down, it doesn't turn down the same way. It depends on your asset class. So A rents, you can see A rents are the red arrow going down. A rents get hurt the most. So they're the most expensive. Not that the people who can afford them get hurt the most, but people just don't want to make a decision. People aren't running out and buying brand new cars today, would be my guess. Fair enough? Okay. But I remember during COVID, nobody's buying cars. Once car prices shot up, right? So everybody goes out, and so Range Rover sales were very slow during COVID. As soon as COVID came, as soon as we were out of it, or we started seeing the light at the end of the tunnel, you couldn't buy a Range Rover, right? And so I think rents are kind of the same way. So A rents are on their way down. They're going down. They've had the most drop so far, probably the highest vacancies in that area, right? And but then when I'm saying hard times come and hard times go, when you come out of whatever we're in right now, 1, 2, or 3 years down the road, A rents go up the first, go up the most, and they go up higher than where they were before they came down, right? So they go down fast, but they come back fast, right? And they come back better. Now, if there's enough pressure on A rents and they drop enough, then it puts pressure on B rents. Fair enough? And then B rents drop, but B rents also come back, but they only come back after A rents come back. So they go down later, but they also come back later. Make sense? Right? And then C rents, typically C rents are pretty good. You're going to experience some increase in vacancy and things like that. But that's probably just because of changing financial situation. A little tick box there on C rents saying that they're probably the safest place to be right now would be a 3-story walk up with the rents of $1,100 or $1,200 or something like that. They're kind of recession proof. But the thing about this is that rents will come back up again. Rents will go down. Rents are going down. Let's make sure they don't go down any more than they need to. But and we'll talk about what you need to be to kind of stay sharp. Okay. So next slide. So what you've got to do in this market, it's going to depend on what type of building you have. So if you have a stabilized building, and that could be an old 1960s, 1970s vintage building, or it could be a newer building, but the point is it's stabilized and it's full. Your plan is different if you're already stabilized. Now, if you've got a non-stabilized building, so you've got a significant vacancy problem, then you've got to pull out all the stops, and you're actually going backwards. You're not staying in the same place. Your rents are going backwards. Your vacancies are going up. You've got to take more drastic steps, right? Number C is if you're under construction right now, or in lease. Yeah, if you're under construction right now, whenever you get your certificate of occupancy, which is going to be sometime down the road, 12, 18 months from now, you're going to be coming into a difficult market, and you're going to have to do a difficult lease up, and that's going to require a different strategy than maybe what you might have had you come to the market in 2017 or 2020 when things were good and the demand was huge and so on. And then D, there are apartments on the drawing board, and there's lots of apartments on the drawing board right now. What happens to them? What options the developers have? So let's walk through each of these scenarios now, right? First, let's think about our client, the renter. Some people are going to lose their jobs. Not everybody's going to lose their jobs. Some companies are going to be cutting back. Not everybody's going to be cutting back. But once there is uncertainty, the same uncertainty that an apartment owner, an apartment developer, a lender is feeling permeates through to your client. So they are concerned about their job, number one, right? Number two, if you're not sure about your job, you got a good job and you're making good money and so on, you might not want to send a lease. You're thinking about everything now, your rent, your utilities, your parking. You're thinking about the location you can live in. Maybe in Kitchener, Waterloo, Guelph, Cambridge. I don't have to live in Kitchener. If I work in Kitchener, I can move out a little bit more. The sales cycle is longer. Okay, so that from the time when they come in and to the time that they rent to the time they move in is longer. But you know what? Not everyone is in the same boat. I think for people who, if I'm concerned about my occupancy, I don't know if I wouldn't approach the renters in my building and say, sign a 2-year lease, I'll give you no rent increase next year or something like that, right? So remember, this doesn't happen to everyone. People are retired people and things like that are all solid. But think about your renter and think about your strategy, right? Okay, next slide, Rod. So the majority of buildings we're talking about probably fall into this category. You've got a stabilized building, but you're seeing some softness in the marketplace. So what are the things, or whether you've got more vacancies now, or whether your rents have gone down a little, or whether you're in the same place as you were 6 months ago, 6 months from now, it's probably going to be more difficult. So what do you do and in what order? Okay, so this is what I think the plan is for the typical stabilized apartment building in Canada. Number one, and the easiest, cheapest, like it costs nothing, is staff sales readiness. Okay, and I've done some LinkedIn posts on this, but we recently shopped 60 apartment buildings in Calgary. And these were all buildings that were in lease up, close to top of the market rents and things like that. 20 of the people answered the phone, right? And that's kind of shocking. So this is clearly not, we're full, we're not answering the phone. These are buildings in lease up at top of the market rents. And we made 60 phone calls and 20 people answered the phone. Okay? And the people that answered the phone, some of them were good salespeople. Many of them just tried to refer the caller to the webpage, right? Which is not what you want. You want to take every webpage lead and turn it into a live phone call so you can personalize the presentation and so on. So staff sales readiness, we do come, what was it, Dave, May 6th, we said, right? To a webinar that we're going to do that's dedicated to staff preparedness and staff readiness. Okay, number one. Number two, start getting proper traffic reporting and do some analysis on it. The simplest number I look for on a traffic report is closing ratios. In a way, it's kind of like a market survey. I would expect my closing ratio, depending on the rent and the competition level, to be somewhere between 10 and 20%. If your closing ratio is 30, 40, 50%, you don't have a rent problem. In fact, your rent's probably too low, right? If your closing ratio is 5%, you could have a bunch of other problems, but likely your rent is too high. So you've got to start tracking traffic. And if people aren't answering the phone in Calgary, they're not tracking traffic. Fair enough? So that's important that you collect data either electronically. There's all kinds of systems that'll collect it. But it's important you track it and you analyze it. And when you look at your traffic report, look at it on a per unit basis. Don't just look at it globally. And I'll jump down to number 5. If you do have to adjust your rental rate, or if you do have to offer free rent, for example, don't just do it across the board, right? Do it where you have targeted problems. I mean, it sounds simple to say, but oftentimes say, well, we offer 1 month's free rent on the entire building, any unit. And the 3 bedrooms, there's no vacancy. And one comes vacant, and they offer 1 month's free rent. You know, you didn't need to do that, right? Number 3 is staff compensation. And I'm actually going to say that most frontline staff are not adequately compensated or not properly compensated. In fact, what I'm saying is a time when maybe your NOI is going down, I'm suggesting that you may want to increase the compensation of your frontline staff, because what they do is more important now than what they did when the buildings were full. Because to some extent, buildings filled up by themselves. Today they don't. It's going to take more work to do it. Apartment readiness, a whole dose of common sense here. The apartment should be clean, renovated and things like that. I think that prior to the downturn, maybe a few years ago, people were renovating the apartment, spending 20, 30, 40, 50, $60,000 per apartment and getting top of the market rents. Now that rents have come off, that massive renovation may not make sense anymore, right? If your rent is $1,200 and you can take it up to $1,800, but the market's softer, maybe you just go in and clean it, do a slap and tickle, and maybe raise the rent to $1,500 or $1,600, and that's enough. And as opposed to spending all that money and only getting $200 more, and so on, right? Concessions. Look, nobody likes to give away free rent. We don't recommend giving free rent sort of willy-nilly. But if you do give away free rent, again, don't do it across the board. It might make more sense to give away free rent in a building that is under construction, where you just got to get full and you've got 100 empty apartments. But please, if you're going to offer concessions, we'll talk about this on May 6th a little bit more. You should use it as a closing tool. You should use it sparingly, and it shouldn't just be across the board. Come on in, we'll have 1 month's free rent, because all of a sudden your frontline staff are going to think 2 months free rent is better, right? And there's data that can show that when you offer free rent, you get a more transient type resident. When the free rent is gone, they're gone, right? So it's a complicated topic, but concession should be offered very, very sparingly. And then resident retention, when you're charging the market rent. So I'm not talking about the people in your building paying way below the market. You'd actually like them to move to raise the rent. But when you're talking about, normal turnovers, that normal turnover can be somewhere between 20 and 30%. And if you're experiencing vacancies, then saving one move out is a double win, right? And so I think you might want to consider putting in a formal resident retention program where you start talking to your residents before they move, right? Not when they come and give you their notice that they're leaving, then it's too late. Then they found something else and so on. You want to be talking to them now. You want to be keeping your service. You might want to be offering them something to stay, whether that be an in-unit, update like a ceiling fan or blinds or something like that, right? And keep in mind that you're paying more attention to your renter today. You're going to show a 2-bedroom apartment very differently to 2 roommates than to a married couple, and where one works from home. Your sales presentation isn't just here's bedroom number 1, here's bedroom number 2, right? You're talking to your clients, you're finding out what their needs are, and you're customizing your presentation to them. All common sense, but it's things that when we are full and when rents are rising, we tend to lose. And now that rents are not rising, it's time to just pay attention to the detail, common sense, and sometimes common sense needs to be taught and trained into your frontline staff. And we're finding that we're getting a fair bit of demand for that today compared to what we were getting, let's say, in 2020. Okay. Rod, next slide, please. So new apartment construction lease ups, and I don't know how many buildings there are in Canada right now that are coming to the market, but my guess it's hundreds of them. And you got to think about why vacancies occur. And vacancies occur for 2 reasons. Either because the marketplace is overbuilt, or because there is demand destruction, or both. Okay, so let's talk about overbuilding. Generally not a problem in Canada, but you see it often in the US. Let's just say about Austin, Texas for now is overbuilt. Okay, there are too many apartments for the number of people living there. Too many developers jumped in, piled in all at the same time and built. except in Austin, it is a rapidly growing city and people from all over America are moving to Austin. So if you're a developer and you've got, let's say, deeper pockets, there's no way you should be dropping your rent. You should just wait because there are thousands of people a month moving to Austin, right? So that's just a marketplace that's overbuilt, but there's no demand destruction. In fact, there's the opposite, right? Now, so that vacancies go up because of overbuilding, but if the market's strong, you have to wait it out, compete a little more, and so on. The other scenario you can have is in another city, the mill closes down, the mine shuts down, the big employer shuts down. That's demand destruction, or there's job loss, right? Now, in that case, you don't wait till the mine opens up again or till the factory comes back or another factory comes. You've got a problem that you're looking at, and in demand destruction, you've got to get full, right? And so I think, so if you take Toronto, for example, I think we probably had both. We've had some apartments built for sure, but we've had a ton of condos delivered. And so the combination of overbuilding in the shadow rental market and demand destruction is causing pressure on rents, vacancies to go up, and things like that. But understand what's causing your problem. I would say in the city of Toronto, for example, there is a oversupply of one bedrooms and dens. Those were condos built by condo developers and sold to investors, and they're probably the wrong product. It's certainly the wrong time to be bringing them all on. But if you're an apartment owner and you've got 2 and 3 bedrooms, you're probably good. In fact, there's a shortage of 3-bedroom apartments everywhere, and I doubt I'd be recommending to anybody that they should drop the price of the 3-bedroom apartments. In fact, you may be able to raise your price of 3 bedrooms because 3 bedrooms are oftentimes now being not necessarily families, they're being shared by renters who are cost conscious, don't have the money. 3 people get together and rent your apartment. They can actually pay more because now you've turned it almost like in a student housing and renting by the bed. Not one size fits all. Every building is different. Every unit mix is different. In bachelor apartments, I would say that you're probably heading for more problems with small bachelor apartments, but you're probably heading for good times in 3-bedroom apartments. So keep that in mind, right? So that's the difference between overbuilding, demand destruction. In some places in Canada, we're going to have overbuilding, but I think across the board, we're going to have demand destruction. And the way you respond to demand destruction is you get full. Fair enough. And that's what you need to do right now. So you need a plan. So when you're talking about new apartment construction, Rod, next slide, it's much more complex. There are way more moving parts. The risk is much higher. So you got to hire and train staff. You got to manage them. You got to market to maximize your asset value. This is what we do. And then oftentimes we're able to sell those buildings for our clients. And that's our business model. So what we do in new apartment construction is spend time with the developer, put the plan together in sort of that Gantt chart format, and then execute that plan. And that's a 1 to 2 year project to stabilize, a good sized apartment building today. That next slide. If you are leasing up a newly constructed building, what you want to get is a checkerboard. Okay. And too often we go to buildings, if you look on the left-hand side, all the apartments on the first 4 levels are leased and none of the ones on the top level are leased. The clear problem here is they're putting too high a price for the view premium, which the renter, your customer, has not agreed with and valued, and they've rented all the lower units, right? Or sometimes you see the whole 07 row leased up and they just priced it wrong. The 07 had a great view on the corner, whatever, right? What you really want to look at, and if you're the developer, you want to see a checkerboard, which you see on the right-hand side. Fair enough? You want to see some apartments leased on the lower floor, some apartment leased on the higher floor, some in the 01 unit, the 07 unit, some in the podium, and things like that. A checkerboard, most times when you go to apartment buildings right in the middle of lease up, we don't see a checkerboard, right? And then you're left with your worst units that you probably priced wrong, left at the end, and all your really good units have gone and been scooped up, by tenants. So, by the way, if there are any questions and you want to put them in the Zoom, you can in the chat box there. So, we've taken okay, Rod, next slide. We've taken the industry concerns of vacancies going up and rents coming down. And we put together a program that we've called the Scary Time Success Program for apartment owners. And we're going to come into your building, and we've been doing this for a long time. We're logically going to walk through your building and look at every step of the rental process, from your sales staff to the rental rate to the turnover in the building, to the competition, to your web page, and things like that, right? So you have to pay attention, and our experience tells us exactly what. I can look at your traffic report on a property if there's good data, and I can tell right where the problem is just from looking at this traffic report. So we've got this Scary Time Success Program, comes with 100% guarantee for our clients. We've been doing this for a long time. We're just going to come in, look at your building, and we're going to tell you what you need to do and what you need to address, and sometimes in what order. Okay. And so that's the program that, if you're interested, you can talk to, next slide, Dave Price, right? You can talk to Dave Price about this. There's his contact information. And, Dave, I'll just let you come back on again and just comment on this. Okay.
Yeah, don't hesitate to reach out, right? You might not think that you've got a problem, or maybe you fully recognize that you do, but we're going to have a discussion about your specific circumstances, and I'll walk you through everything about how the program works and how we deliver the value to you, and we'll customize the solution specific to your needs. You'll come away with plugging gaps, actionable tips and tools, and it'll be high impact. So reach out to me.
Dave, no, right, Dave, the first thing that when you talk to Dave, the first thing we're going to do, or you can do it right now, we are going to mystery shop your frontline staff. Fair enough. The easiest, cheapest, fastest thing to fix is a lack of sales coordination on the front line. And I got to tell you that many, many times that is our problem. Okay. And that's also your easiest problem to fix. And quite frankly, it's not your staff. I mean, it's not your staff's fault. You've been fooled with them just getting through the day, right? And all of a sudden now the marketplace has changed, doesn't mean that they're going to change. I mean, their compensation may not change, may not have changed, and all of a sudden they're going to be, but if you get their compensation aligned with your compensation. Anyways, we've been doing a number of these, have done it over the years. We are the doctors that can quickly look at the patient and say, here's the problem, and then we'll give you the tool to fix them. Okay. So there was a good question here. Yeah, rents did go down, and in I guess you're talking here about Toronto, Raja. And it is a excess of condos in the marketplace. But again, I would refer that is in the 1-bedroom and the 1-bedrooms and dens, right? I think there's more condos coming to the market in the next couple of years. And then by the time we get to 27, 28, there's going to be no condos being built. But there's still a lot of supply coming. And the part about the condo supply coming is that it's not a disciplined investor. Okay. You own one condo and it's $3,000 in rent and it's empty for a month. That's $3,000 you lost. The second month, you lost $6,000, right? That condo market, that condo investor does not have the discipline that a pension fund would have. And when they've got one vacancy, they're 100% vacant. So the condo rental market is the bad boy here, right? And that's the person dropping their rents probably the fastest, because they're small owners, and that's what they've got to do. So if you've got a lot of condos in your market, and if you're in Toronto, you will, and you've got a lot of 1-bedrooms that have vacancies and so on, I'm going to use a term here I hate using, but it's a race to the bottom, right? And that guy who only has one unit, or an investor with 2 units or whatever, they are going to win that race to the bottom because their situation is dire. They are 100% vacant, or they are 50% vacant, or something like that. So you need to understand that. And I would say that in a difficult market, after my rental agent has gone through a proper process and vetted the client, overcome objections, closed, if the prospect won't rent, I would say to them, Mr. Prospect, what do I got to do to get you to rent here today? Really simple question. What do I have to do to get you to rent here today? Right? Now, if you only got 1 vacant or 2 vacant in your 200-unit building, it's doubtful your rental agent is going to do that. But if I had one empty condo in Toronto and it was 100% of my investment and things like that, that's what I'd be thinking, and that's what I'd be saying to that person. And keeping in mind that you are competing in that marketplace.
Hey,
Okay.
Derek,
So
the one thing I like about Raj's question is he's thinking down the road. Maybe you want to speak to pipeline in terms of right now we have a plethora of condo availabilities coming online, but maybe speak to the pipeline of new apartment construction 2, 3 years out.
well, so the condo market, whatever's being built right now, isn't going to stop, and those guys are buying what they're buying. Fair enough. So that's 20, 40,000 units, but it's going to stop at some point. But there's still going to be a lot of those one bedrooms and dens that are right. There's still going to be a lot. It got massively oversupplied very quickly, right? I think that topic for another day at another time would be that it would be logical to expect that you're going to see more government incentives coming in to build rental apartments, right? So depending on who gets elected, it looks like if the Liberals get elected, they think they should be developers, they should build houses, and they should, and so on. If the Conservatives get elected, the Conservatives think the private sector should build it, and they're going to bring in programs. They're talking about a 1031 rollover type program we have in the US, where if you sell your building, you don't pay tax, you roll the next deal, you eventually pay the tax. They could bring in a really great program to bring be the MERV program, right? Where all your soft costs are written off in 1 year. And that would again stimulate rental development. So if you stimulate a lot of rental development, that is competition, right? I mean, that's the business friend. This is a free market economy. We're supposed to compete against each other, right? It's rent controls that really kind of messed things up for us. But the upside to the downside we're looking at in these scary times is that we could get actually good government policy to create good housing for Canadians, right? In everything, Rod. When you go through something difficult, right? And this is going to be difficult. Don't know how difficult, don't know how long, but let's just get ready. And everything that I've said here in terms of preparedness costs very, very little. But there's a shoe leather cost to it, and I think some of it is a change in your culture and in how you manage your buildings. Okay. Rod, I think that's everything that I wanted to say, and we appreciate all of you being here today. Maybe let me see. Yeah, and as usual, we'll make this recording available to you. Next event, which is probably much more drilling down what I'm talking about here, is on May 6th. Okay, Greta, good to see you there, my friend. Okay.
Derek, I just
Thank you
want
very much,
to,
everybody. Okay.
can I just say one thing before we go?
Yeah, Dave. Yeah.
Yeah, we're getting called in as a specialty group to a lot more difficult situations, right? It's natural for the times that we're in. And you
Sure.
know what? As we go in and we do the deep dive investigation, you know what the number one thing that's being uncovered, the biggest challenge that we're seeing out there? You kind of touched on it earlier about the leasing performance. But
Yes.
what aspect that we're most alarmed about in that scenario is leasing agents tend to be fearful or resistant to asking for the sale. And it's
Yes.
wild. You talked about it, we came out of kind of a boom time. We think that if leasing agents cut their teeth during that time, they became more like order takers, right?
Yes.
They've lost that skill to sell, they've lost that skill to ask for the sale, and it's a big problem. This is just one of the things that we identify in our success program for during scary times, but it's one element, right? The skill set of your leasing team, it needs to be sharpened up. That's just one facet.
No, Dave, that's a good point, and it really is the easiest one to address also, right? And so on. Okay, all right. So thank you very much for joining us, and we'll see you again soon.
Bye, everybody.